It's a great pleasure to have with us Glenn Surowiec, who heads up GDS Investments, which he started in 2012, following about a decade at Alson Capital Management. Glenn has assembled a very strong track record as an investor, and actually the reason for this conversation is really to get an update from Glenn on two ideas he articulated when we spoke just about a year ago, I believe in April 2012, and those two ideas were Overstock and Bank of America warrants. Now, Glenn, you talked about having sort of a, if I recall correctly, a 5-year thesis on Overstock, that it could be a five-bagger within that time frame, and it's actually been a five-bagger within a year. The stock has gone from about $5 to about $25, and so your thesis there has played out very nicely. I look forward to getting an update on that, and as we all know, Bank of America has roughly doubled, maybe more, over that time frame, and maybe, Glenn, you can let us know what the warrants have done, but I gotta assume they have performed very strongly. So with that, I'll just let you kind of essentially tell our audience how the ideas actually played out versus your thesis, and what your view of both of those investments is today.
Well, thanks, John, for that introduction. So last April we got together, and you asked for a couple ideas, and I was lucky enough that I had two high conviction ideas at that time. Overstock was at $5, and it's about 25 now. And the warrants, Bank of America A warrants, which expired in January of 2019, they were, I think, a little over $2, maybe $2.25, and they're just south of $6 right now. So obviously both have worked out. And both have worked out a lot quicker than I thought. And let's kind of maybe start with Overstock. And I think that a lot of what happened in 2012, a lot of that foundation was actually built up with just being just knowledgeable about the company and following their history and listening to calls and really kind of understanding some of the key players in the business model and how it's changed. So I felt really strongly in 2012 that I could kind of draw on a lot of that history when it seemed that we were sort of in that moment where there was a lot of noise, and I really just try to separate the noise from the facts, and I think the facts were pretty overwhelming. In Q1 of 2012, management pretty much telegraphed, what stage one of the turnaround was going to look like, and I think that they had, aggressively kind of gone after the cost structure, sort of well before it had an impact on the financial statements. And so really, step one with Overstock, I guess what I was hoping would happen, and there were sort of two components. One I was fairly certain of, and that was just stabilizing the cost structure. And again, we saw that it was quarter in, quarter out. We saw it quickly change. We saw an improvement in their contribution margin, and we saw lower tech G&A expenses. And I guess like all of those things were within management control, and they're things that they really highlighted, quarter after quarter, and we kind of saw, just a really, really nice progress throughout the year. And in 2012, revenues were up modestly. I think it was like less than 5%, maybe 4%. But you really saw this big, big expansion in contribution margin dollars, and they were up double digits. It was up 15%. And then you saw tech G&A, which was down 9%, and that really kind of stabilized things and helped the bottom line. And that was something that I knew was going to happen, and I thought the market wasn't pricing in that fairly high probability improvement. And I think my reason for calling it a five-bagger, I think I eventually needed some pickup in the top line, and really that all kind of came about in this latest quarter. where revenues were up 19%, and you really, you saw a continuation of the operating leverage. Contribution margin was up 22%, and tech G&A was up only 9%. So, they were able to grow the top line, but do so in a quality way. And that was really the maybe of the analysis. I thought there was a pretty good high probability, just given their track record. It seems though, they do have some year-to-year volatility, but really over the long period of time, this is a business that has a pretty good tailwind, and it's also a business that, on average, they've been able to grow the top line in excess of 15%, actually 20%, albeit on a smaller base. But I felt that there was a really, really strong possibility that they could get back to double digits, and with that, the market will reprice because the cost structure, the profitability is improved, but then they'll sort of reprice again once they get visibility around that top line. And so listen, the price is up 5x. Value has not gone up 5x, and if I could just make a general comment that at the margin, it's attractive, but it's certainly not as mathematically attractive as it was a year ago. I sort of, in my mind, I kind of have a core position. It's not nearly as high as it was a year ago for, the reason that I just laid out, that, certainly, price has gone up a lot more than value. But I do think that with this model, because of the top line potential over the long term, because of the operating leverage, because it's capital light, because it generates really unique returns. It's not an all or nothing thing with me. So I still own a core position. It's obviously not as great as it was a year ago, but it's 50% of growing sales, which is where it is now. It's at $25, and sales per share this year are probably going to be somewhere between 50 and 53. And the fact that I have that growing, I don't want to get too cute. I want to manage the exposure, but at the same time, there's other models in this space that if they can continue to sort of execute and do so really within a model that has a relatively long runway, I am willing to kind of own a core position, and give them more rope than I would other models. So hopefully I'm not dancing around. Hopefully I'm not dancing around that too much.
No, not at all. I think that's pretty clear, and clearly not surprising at all that after it's gone up fivefold that you would be somewhat less enthusiastic than you were a year ago. But what I just find fascinating, Glenn, is, if you think back to a year ago with this at $5, we've had $20 per share of upside actually materialize over a year. And what was the actual downside, with this at $5 and shareholder-friendly management in place? You had a couple of core shareholders in Fairfax and Chu Associates supporting the company. I mean, can you even try to quantify what the downside would have been at $5 when we spoke?
Yeah, I mean, I think that's a great point. I think you had layers and layers and layers of margin of safety sort of built into those prices. I mean, it was 10% of sales. It was a business that was cash flow positive. It was a business that, albeit 2011 wasn't the best year, over a long period of time, they've really done some exceptional things. You correctly pointed out that they had shareholder-friendly, value-oriented outside owners, but they also had this really shareholder mindset with, Jonathan Johnson and Patrick Byrne, that you knew they weren't going to squander capital in a way that a lot of companies do. And I think the only thing you can point to is just my behavior at that time. And this was a high conviction position. It was my largest position at the time. And I come back to my original point that there was a lot of noise. There was a lot of misinformation. There was a lot of, short-termitis, if you will. A lot of just, the market seemed to kind of really focus on what had recently happened when obviously all of that and then some was already priced in, and they sort of ignored the fact that on the same call, while management was reporting, really just it wasn't a disastrous year, but this wasn't an overstock year. They, basically telegraphed what the next couple quarters was going to look like from a cost perspective. I mean, in January and February of 2012, they had already aggressively attacked the cost structure, just through a variety of different ways. And you knew that that was going to have an impact starting in Q1 and then Q2 and Q3. And so I sort of thought that if they executed on what I thought were very, very high probability targets, that the stock was going to double and probably go up 2.5 to 3x. And I knew in order to get to a 5-bagger, we needed the top line to kind of stabilize, but then we needed to kind of return to growth. And we got that. But, to your point, I don't think there was any downside. I mean, it's obviously there wasn't a 0% probability that, maybe the top line contracts and continues to contract. Maybe the cost structure doesn't improve as rapidly as they think. But again, a lot of these, it's if you have a CEO that has the ability to execute and all the variables are right in front of him or her, absent someone who's just completely dishonest, which doesn't describe anyone affiliated with Overstock, that they had laid this whole roadmap out in January, and that's why I felt really, really strongly that the stars were aligned, really.
Well, I think there's a great lesson here in terms of just the kind of asymmetric risk-reward that was available here. And normally when I think of these kinds of lopsided risk-rewards, it might be a company that's in real trouble, maybe even a financially leveraged company that's gotten beaten down. But this wasn't the case here. This was really just a case of executing on what management already said they were going to do, and just a dirt cheap valuation. And
I think there was just a lot of misunderstood and a lot of short-sighted analysis. And I think you really hit on there's very, very few of those so-called 5-baggers where there is almost no risk. I mean, you correctly identified a lot of those companies have either one of the following characteristics. They have lots of leverage. Maybe it's poorly structured leverage, or they have a business that is really under assault, whether it's a Kodak or just something else that there's this very, very real, legitimate competitive threat that they need to deal with, and the probability of them kind of coming out the other end successfully, the probability is it might be 50-50 at best. And I really feel that it's just, I'm glad that we were able to talk when we did, because I really had these two high conviction ideas. And as you know, a normal market environment, obviously we had a lot of those in early 2009, but a lot of those, by and large, dried up come April 2012. Yeah, there was interesting things, but really nothing as compelling as Overstock and the B of A warrants.
Well, we're going to make the original interview available alongside with this conversation. I really want to encourage everyone to go back and listen to it, because it's essentially a point-in-time kind of thesis that was presented by you, and I just think it's very instructive to listen to that and maybe even think, would I have actually invested in Overstock or the B of A warrants for that matter, based on that thesis, or would I have kind of let the noise drown out what were some very compelling facts? Glenn, maybe we can switch gears to B of A now and just get your update on why it unfolded the way it did, and what your thesis on B of A is today.
Sure. So I just to remind everybody, I mean, I owned both the common and the A warrants, but I was pitching the A warrants back in April 2012. And I think they were, two and change, somewhere between 2.25, maybe and 250. And the A warrants, I mean, listen, it's the government received lots of securities in exchange for their investment via TARP, and to unwind from that, they listed a lot of these warrants publicly, and a lot of the big banks and the insurance companies, you can find them all out there. And what I liked about the A warrants is that there was just multiple ways that you could win. I mean, the strike price is $13.30, but it gets adjusted when dividends exceed 4 cents per year, which I believe is on the verge of happening. So you get you get an adjustment to the strike, a 1-for-1 adjustment. And once that happens, you get adjustments for to the extent they spin off Merrill or buybacks and things like that. And plus, they warrants generally don't last until 2019, so they sort of had like a 10-year life. We're here in 2013. There's 6 years left, a little less than 6 years. And I felt with B of A that for every reason why I was wrong to invest in B of A, which seems evident to everybody right now, but it wasn't obviously at the time. But it was I never owned B of A until 2009, and I was familiar with Hugh McCall, and I was familiar with their history, and I was familiar with Ken Lewis, and I was familiar with how they kind of built that franchise. And I was I owned Commerce Bank, and I owned Vernon Hill, and I owned people that grew within the core, and they could create value by really finding out what they're good at and kind of doing more at it, and adding a zip code, and adding a county, and adding a state, and things like that. And B of A's strategy under Hugh McCall and Ken Lewis never really made sense to me. And for all of the reasons that it didn't make sense to invest in B of A in 2005 and 2006 and 2007, to the extent you take all of those conditions away and the price comes down, that's really what we had. And you had not only a great opportunity to buy in 2009, but then you had this second opportunity in late 2011 and 2012 to buy it again. It's just ridiculous prices. So I felt that Brian Moynihan was the right guy at the right time. I felt it was a multi-year recovery that largely was going to consist of very low-risk decisions. It's about downsizing the non-core businesses while building the core ones. And it's about, building capital and liquidity. It's about reducing debt. It's about, just making what I think are just intelligent choices about where they were in the cycle. It's about, shrinking the mortgage service portfolio. It's about, executing on new BAC, which is this, this $8 billion cost expense reduction program that they have. It's about working through the litigation. These are not really sexy things. They don't get headlines quite the way M&A does. It seems that a lot of investors and the media they tend to sort of like acquirers, but when people are sort of de-risking and deconsolidating, they seem to kind of gravitate to other stories. But this is a very, very simple story, and it just required leadership and a culture and the ability to execute. And I really sort of felt strongly that all of the variables that would change perception about B of A, all of those variables, and thus allowing the stock to get revalued higher, all of those variables were really right in front of the management team. Yeah, do you need a slightly better economy? Well, you need an economy that's not contracting or not in free fall. But, real GDP is 1%. Some say it might be lower or higher depending on how you count for inflation. But, bottom line is we don't have this robust economy. We don't need it either. What we need is just a normal level, a normal functioning economy, and that sort of allows them to kind of earn their way out of the problems and earn their way out of some of these liabilities and slowly change perception about who they are and what they do. And at the time, you had book value that had been sterilized for 3 years. They had already, issued equity. They had raised their level of liquidity. They had paid down debt. So you had book value that had enormous integrity. And you could buy the equity at 1/4 book value. You could buy the A warrant for $2, and it was absurd on on any level. And I felt as strongly about this, and this was also a top 3 position for me, as I did about Overstock. And I really believe that, Brian, I think the next few years is going to be a continuation of the last few years. I think it's, figuring out what businesses that they want to be in, that their customers want them to be in, that their shareholders want them to be in, and, really make sure that they're allocating capital to get better at those businesses and really withdrawing capital in some of these marginal businesses that have been really just added to the organization over the last, really the 15 years leading up to 2007, 2008. And I think that simplified operating structure will ultimately yield something that reflects, what I consider a normal, well-run bank valuation, which is, certainly north of 1x book. They don't need Wells Fargo, and they're certainly not Wells Fargo in terms of that track record. But I think it's a business that book value will grow here from $21, and I think that their valuation also will grow to about 1.25x before this cycle plays out. I still think that Bank of America is a double from here within 3 years, and I would say probably maybe triple in 5 to 6 years.
Which would make the warrants obviously still very attractive.
Yeah. I still own the warrants in size.
Great. Well, thank you so much, Glenn, for taking the time to update us and really let us know how these theses played out. I think it's just a very instructive learning opportunity for all of us to learn. I would be remiss, though, to not ask about your level of conviction on anything today as compared to a year ago.
Yeah, so I think what I've tried to do, I think there's some interesting things, not across the board, not in every industry. I think that, there are some industries that have pulled back a little bit, and I'm natural gas sort of stands out where what's happening at Chesapeake with the new leadership and sort of the new ownership, and I think Southeastern's involvement and Icon's involvement. And I'm always more comfortable in stories that are, getting leaner and smaller and more focused, and the balance sheet is sort of, getting restructured, than I am with the opposite strategy, which, just seems to be, a go-go growth strategy. So yeah, Chesapeake is something I'm closer to than I was a year ago because of those variables that I laid out. I have, a couple fairly decent-sized positions in, a couple spin-offs or, just spin-offs that will probably happen in Q3 or Q4. I am trying to be less and less market-oriented and really identify companies that haven't really participated in the rally. And some of it is self-inflicted. I would rather take company-specific risks than market risk right now. And Chesapeake's a perfect example. I mean, I think natural gas is a little bit out of favor. And I think there's also some Chesapeake-specific problems, that were real headwinds over the last couple of years, and I see them kind of starting out now where, the problems are now solutions, and I see, just some things that might go their way here over the next year or two. I think there's some names in the defense sector that look interesting, as that sequestration overhang kind of, dissipates here. But across the board, listen, things have moved. I still am, overweight and long financials. And the reason being is that I do think there's very real symmetry in how deep the downturn versus how prolonged the recovery. And I think the error, this is 1991, at least in that sector, and I think the error back then was short-circuiting, a lot of these banks that really kind of came out of very, very unique crisis. And I think that, people doubled their money with Wells Fargo and, were quick to do that and then, saw it go up 3 or 4-fold from there. And if value is growing, and I do think that the earnings power is still very, very high in that area. I own Wells Fargo. I own J.P. Morgan. I think Citi is something you want to look at now that they're sort of entering a new phase and they have new management. There seems to be assets there that can be repositioned, and certainly Bank of America. But I think you have to be very, very select in what you're doing today.
Great. Well, thank you so much for that generous update, Glenn, and for sharing your views. We certainly want to bring you back as soon as you gain anywhere close to the kind of confidence that you had on Overstock and B of A last year. It sounds like you might be close on a couple of companies, and so we look forward to having you back, articulating another thesis to our members. Maybe just as we wrap it up, how can folks learn more about you and your firm?
Sure. Well, my email is Glenn with 2 N's at gdsinvestments.com, and I have a website, www.gdsinvestments.com, and I have tabs on there with philosophy, performance history, and my bio, and that's probably the easiest way to get a hold of me.
Wonderful. Well, Glenn, again, thank you so much for taking the time.
Well, thank you, John, and hopefully we can do this again real soon.